Good afternoon, and welcome to the fiscal year 2026 fourth quarter financial results conference call for Dell Technologies, Inc. I'd like to inform all participants this call is recorded at the request of Dell Technologies. This broadcast is the copyrighted property of Dell Technologies, Inc. Any rebroadcast of this information in whole or part without the prior written permission of Dell Technologies is prohibited. Following prepared remarks, we will conduct a question and answer session. If you have a question, simply press star, then 1 on your telephone keypad at any time during the presentation. I'd like to turn the call over to Paul Franz, Head of Investor Relations. Mr. Franz, you may begin.
Thanks, everyone, for joining us. With me today are Jeff Clarke, David Kennedy, and Tyler Johnson. Our earnings materials are available on our IR website, and I encourage you to review these materials. Also, please take some time to view the presentation, which includes additional content to complement our discussion this afternoon. Guidance will be covered on today's call. During this call, unless otherwise indicated, all references to financial measures refer to non-GAAP financial measures, including non-GAAP gross margin, operating expenses, operating income, net income, diluted earnings per share, free cash flow, and adjusted free cash flow. A reconciliation of these measures to their most directly comparable GAAP measures can be found in our web deck and our press release. Growth percentages refer to year-over-year change unless otherwise specified. Statements made during this call that relate to future results and events are future-looking statements based on current expectations. Actual results and events could differ materially from those projected due to a number of risks and uncertainties, which are discussed in our web deck and our SEC filings. We assume no obligation to update our forward-looking statements. Now, I'll turn it over to Jeff.
Thanks, Paul, and thanks everyone for joining us. FY26 was a defining year in our company's history. We delivered record full-year revenue and EPS. Revenue reached $113.5 billion, up 19%, and EPS grew 27% to $10.30. We converted that performance into record annual cash flow over $11 billion and returned $7.5 billion to shareholders, including 54 million shares repurchased, more than doubled last year. The AI opportunity is meaningfully growing and transforming the company. In FY26, we closed $64.1 billion in AI orders, shipped $25.2 billion, and exited with a record $43 billion in AI backlog. Powerful proof points that our engineering leadership and differentiated solutions are winning. We are executing with discipline and speed. We are gaining share in our PC business and strengthening ISG with strong margins in traditional servers and storage, all while positioning the company for the AI era. It was a monumental year. We exit with strong momentum, and I couldn't be more proud of this team. With that, let me turn to the key highlights for the quarter. We delivered a record quarter. Q4 revenue was $33.4 billion, up 39%. And earnings per share was $3.89, up 45%, driven by disciplined execution and demand for our AI solutions. While operating in a dynamic environment, we saw record cash flow generation and above-trend capital returns for shareholders. Now let's move to AI. We capped an already strong year with an exceptional quarter for AI. Record orders and broad-based demand. In Q4, we booked $34.1 billion in AI orders, evidence that demand is accelerating as customers deploy AI at scale. We shipped $9.5 billion in AI servers in the quarter. We exited Q4 with a record $43 billion in AI backlog, and our pipeline continued to grow sequentially, even after converting $34.1 billion of orders, a clear sign of sustained momentum. For the full year, AI orders reached $64.1 billion. Our customer base surpassed 4,000 with growth across neoclouds, sovereigns, and enterprise customers, evidence that demand is broadening across all customer types. We're winning for the reasons we've outlined all year. Engineering for performance and time to market while optimizing TCO for AI workloads, deployment and installation at speed and scale, ongoing lifecycle support that keeps clusters up and running, and DFS financing. We're doing this with discipline. Profitability is in line with our mid-single digits operating margin target. We like our position, the line of sight we have with our backlog and pipeline, and the advantages our scale and supply chain bring. Moving to traditional servers, demand significantly outpaced supply in Q4. With strong double-digit demand growth across every region and momentum accelerated through the quarter as customers prioritized access to compute for critical workloads. We saw broad-based strength with units up, a larger active buyer base, and a richer mix of our 16th and 17th generation platforms as customers shifted to dense, high-performance configurations. The ROI to refresh is compelling. Even at higher ASPs, customers see a 7-to-1 consolidation when upgrading from the 14th generation to our latest platforms. The runway is substantial. A majority of the install base remains on 14th generation or older servers, creating a significant opportunity to modernize, improve performance, and lower the cost of ownership. Traditional x86 is benefiting from AI infrastructure buildouts. While many AI workloads rely on specialized GPUs, traditional compute remains essential for orchestration, data processing, and inference support. As customers deploy AI, they are modernizing broader AI estates, refreshing and expanding general-purpose environments. Turning to storage, revenue was up 2% with continued outperformance from our Dell IP portfolio. We saw double-digit demand growth in Dell IP with momentum across PowerMax, PowerStore, PowerScale, ObjectScale, and data protection. All-flash arrays delivered their third consecutive quarter of double-digit growth. PowerStore, our primary mid-range platform, posted its seventh consecutive quarter of double-digit growth. Profitability improved, supported by our higher Dell IP mix. Lightning, our parallel file solution, remains on track for general availability in the first half of the year, with early customer deployments already underway. Turning to CSG, revenue grew 14%, and we gained share as the October momentum carried through November and December. We leaned into share and expanded our buyer base, broadening the portfolio to reach more of the market, including the lower end of the commercial market, emerging markets, consumer, and education, and by targeting strategic accounts. These actions expand our install base and position us for future refresh cycles. As we leaned into growth, we saw a higher mix of competitive large bids and customer expansion than planned. A higher than normal industry channel inventory levels, which delayed price increases. We have already taken actions to address each of these. We implemented pricing moves effective January the 6th to reflect our higher input costs. Orders margins improved and are the basis for all new orders. We remain confident we can operate CSG within our long-term value creation profitability framework. Commercial revenue grew 16%, our sixth consecutive quarter of growth, with demand up for the eighth quarter. We are seeing growth across geographies, strong large enterprise demand, and traction in the lower end of commercial where we set to expand. The refresh cycle remains a meaningful opportunity given the large installed base of devices that are over 4 and 5 years old. Consumer revenue was roughly flat, with demand up for the second consecutive quarter, supported by strength in gaming. Before I wrap up, a quick update on the supply chain and component costs. Across the industry, the environment remains highly dynamic, with unprecedented AI demand creating sustained supply tightness and frequent pricing resets. In Q4, we did what we said we would do. Shorter quote validity periods, more dynamic pricing, and a tighter alignment between our supply chain, sales, and pricers. We saw the benefit of this in ISG and expect it to extend to CSG. Given CSG's higher transactional volume and deal velocity, repricing to reflect multiple cost changes takes longer to flow through. We're executing our operating model with urgency, securing supply as the first priority. Our scale, direct model, world-class supply chain, and long-standing supplier relationships are a real advantage, and they become even more visible in periods of disruption. We are managing this environment in real time, applying lessons learned from prior cycles to improve resilience and to strengthen our position. In closing, FY26 was a pivotal year for Dell. We delivered record performance, converted it into record cash generation, and returned significant capital to shareholders, all while building a stronger company. We out-executed across the portfolio. ISG is at record levels with accelerating AI demand. Traditional servers is growing sharply with demand outpacing supply. Dell IP storage continues to outperform the market, and CSG is gaining momentum with share gains in Q4. We are operating with discipline, lower OpEx alongside meaningful double-digit revenue growth. We've made the company more agile, which is on display in this commodity environment. Bottom line, we enter FY27 with momentum, a strong backlog and pipeline, and a proven operating model. I'm excited about the road ahead and proud of our team's execution. With that, let me turn it over to David to walk through the financials and our outlook.
Thanks, Jeff. It was a record year for Dell, and as Jeff mentioned, we're very excited about what's ahead. The team executed extremely well this quarter, delivering record revenue, EPS, and cash flow with strong returns to shareholders. Total revenue was up 39% to $33.4 billion. Gross margin dollars increased 18% to $6.8 billion. Gross margin rate was slightly better than anticipated at 20.5% and reflected a mix shift to AI servers, with AI revenue up more than 4x year over year, and improved profitability in storage. Operating expenses were up 5% to $3.3 billion, primarily from variable compensation tied to outperformance. We continue to drive meaningful scale within the P&L, with OpEx down 320 bips to 9.9% of revenue. Operating income grew 32% to $3.5 billion, or 10.6% of revenue, primarily driven by higher revenue. Net income was up 36% to $2.6 billion, primarily driven by stronger operating income. And our diluted EPS increased 45% to $3.89, a record. Moving to ISG. ISG revenue was a record $19.6 billion, up 73%, marking 8 consecutive quarters of double-digit revenue growth. Before I get into the categories, we are now breaking out AI server revenue from overall server and networking line, reflecting the scale of the business and growth we expect to see going forward. AI server demand remained exceptional, with records across the board. We had $34.1 billion in orders, $9.5 billion in shipments, $9 billion in revenue, and an ending backlog of $43 billion. In traditional server, demand improved throughout the quarter, outpacing revenue with stable profitability. Traditional server and networking revenue was $5.9 billion, up 27%. Storage revenue was $4.8 billion, up 2%, with strong demand across the Dell IP portfolio. Dell IP demand outpaced market growth, and PowerStore remained a bright spot with 8 consecutive quarters of growth, 7 of which were double-digit. ISG operating income was a record $2.9 billion, up 41%, marking 7 consecutive quarters of double-digit growth. This was driven primarily by higher revenue. Operating margin was 14.8%, up 240 basis points sequentially. The sequential improvement was driven by scaling and strong storage profitability due to higher mix of Dell IP. Turning to CSG. CSG revenue was up 14% to $13.5 billion. Commercial revenue grew for the 6th consecutive quarter, up 16% to $11.6 billion, while consumer revenue was roughly flat at $1.9 billion. CSG operating income was $0.6 billion, or 4.7% of revenue. As Jeff mentioned, profitability reflects strategic share capture in a highly competitive market. This is building our install base and expanding our services and attach opportunities, positioning us well for the refresh cycle ahead. Moving to cash and the balance sheet. We delivered a record cash quarter with cash flow from operations of $4.7 billion. This was primarily driven by higher profitability and sequential revenue growth. We ended the quarter with $13.3 billion in cash and investments, up $1.9 billion sequentially. Our core leverage ratio is at 1.4x, in line with our target. We returned $2.2 billion to shareholders this quarter, including repurchasing 14.9 million shares at an average price of $125 per share and paying a dividend of approximately 0.53 per share. For the year, we returned $7.5 billion and repurchased roughly 54 million shares, more than double the amount of shares we repurchased in FY25. Looking ahead to FY27, we're raising our annual dividend by 20% to $2.52 per share, well above our long-term value creation framework. Additionally, the Board of Directors approved a $10 billion increase in our share repurchase authorization. These actions reflect our confidence in the business and our ability to generate strong cash flow in any environment. Next to guidance. Looking ahead to FY27, we expect to build on a record FY26 and deliver another exceptional year. AI demand continues to accelerate, and our value proposition is resonating with customers and driving continued wins and success. This is demonstrated by $10 billion in shipments in FY25 and 150% year-over-year growth to $25 billion in FY26, with an exiting backlog of $43 billion. For FY27, we expect $50 billion in AI revenue, about 100% growth year-over-year. This outlook reflects the composition of our existing backlog, customer readiness, and delivery schedules. Across the rest of the business, customers are assessing their needs and priorities in an environment where component demand is outpacing supply, which is elevating input costs and extending lead times. We have priced to offset these pressures, and our guidance incorporates a prudent view of second-half demand while navigating this dynamic environment. For full year, we expect revenue of $138 billion to $142 billion, up 23% at the midpoint of $140 billion. ISG is expected to grow in the mid-40s, driven by roughly 100% growth in AI revenue. Traditional servers and storage are expected to be up mid-single digits, with growth concentrated in traditional servers and more weighted towards the first half. CSG is expected to grow roughly 1%. Margin rate expansion remains a priority. We're maintaining pricing discipline, and our transition to Dell IP storage is accretive to margins. Excluding the impact of AI mix, our gross margin rates are up year-over-year. We expect operating expense dollars up low single digits, delivering significant operating leverage as we continue to invest and modernize, simplifying, standardizing, automating, and enhancing our operating model with AI. We expect ISG and CSG operating income rates to be at the lower end of our long-term framework, reflecting the rapid mix shift to AI and the near-term CSG margin dynamics we discussed earlier. Operating income is expected to grow approximately 18%. I&O is expected to be between $1.4 billion and $1.5 billion. Diluted non-GAAP earnings per share is expected to be $12.90 plus or minus 25 cents, up 25% at the midpoint. You're seeing the operating model at work with strong EPS growth driven by significant expansion of our AI business, growth and improving profitability across the rest of the portfolio, meaningful OpEx scaling, and EPS leverage from our share repurchase program. We're leveraging our strengths in a dynamic environment. For Q1, we expect revenue of $34.7 billion to $35.7 billion, up 51% at the midpoint of $35.2 billion. ISG is expected to grow over 100%, supported by $13 billion of AI server revenue, and CSG is expected to be up roughly 2%. Operating expenses are expected to be down low single digits. We expect operating income to be up roughly 60%, with sequential improvements in CSG operating income rate. We anticipate a diluted share count of roughly 664 million shares. Diluted non-GAAP earnings per share is expected to be $2.90, plus or minus 10 cents, up 87% at the midpoint. In closing, we delivered an extraordinary year with record revenue, EPS, cash flow, and capital returns. Revenue reached $113.5 billion, up 19%. EPS grew 27% to $10.30. We generated over $11 billion in cash and returned $7.5 billion to shareholders. Our focus is clear: drive durable shareholder value through consistent execution, profitable growth, and robust cash generation through any cycle or environment. I'm excited about the year ahead. We have the portfolio, operating model, discipline, and multiple levers to deliver growth that exceeds our long-term value creation framework. Thank you to the team for their outstanding work, and thank you all for your time. And now I'll turn back to Paul to begin Q&A.
David, let's get to Q&A. In order to ensure we get to as many of you as possible, please ask one concise question. Operator, let's go to the first question.
We'll take our first question from Tim Long with Barclays.
Thank you. Try to be concise. It did want to just follow up on the AI servers. Obviously, pretty huge order number there, really good performance. Just curious if you could kind of provide us a little color. Clearly, given the demand backdrop, it seems like you're not really seeing any, memory price impacts on that business. But I am curious, as the business scales continually, it seems like you're maintaining that mid-single digit operating margin, which is excellent. But as we see scale and all the diversification you're talking about, maybe you could just provide a little color on other opportunities, either on the margin front or pull through of other business as that business reaches, a much broader, more diversified customer base. Thank you.
Yeah, Tim, I'll take the question. Let's start with, we had an extraordinary quarter taking $34 billion worth of orders. And I think equally important, and we tried to call this out, the 5-quarter pipeline grew as well. We didn't drain it. We actually grew it. And we grew it across all customer types, CSPs, sovereigns, neoclouds, as we call CSPs, and enterprise. Enterprise in particular, I'd call out in Q4 demand is very strong. We now have over 4,000 customers. We saw our enterprise AI business grow significantly quarter over quarter, and very encouraging. And we're seeing AI deployed across many use cases in enterprise. So the backdrop of demand continues to be strong. And you called it out. We tried to call it out as well. We operated throughout the quarter and over the course of the year in that mid-single digit operating income. With what we see in front of us, there's no reason to change that. That is our guidance of where we can operate this business, and we're going to continue to grow it. It's exciting to say that we can grow it twice what it was this year. We grew orders 6 times over the previous year, and we're excited about the prospects of growth. And probably a backdrop from a technology perspective, as we see inference ramp, inference is driving more tokens, tokens drive more compute capacity and intensity, and ultimately that is good for the revenue stream of the company.
Okay, thank you.
And we'll take our next question from Mark Newman with Bernstein.
Thanks so much for taking the question. Great numbers, very impressive numbers on AI servers. I wonder if you could talk about the profitability of AI servers, given the huge numbers you're posting. Any change in directionally versus previous quarter and going forward that we may anticipate, given the huge upside on the top line? And similarly, I guess we'll get to this later in the call, but a little bit more explanation on how rising memory prices are impacting profitability in CSG and traditional servers would be appreciated. Thanks very much.
So 2 questions. So the first one, I'll reemphasize what we just talked about. We maintained throughout the quarter and the guidance that David just talked about that we can operate AI at the velocity we're seeing in the mid-single digits. We have a significant technology transition in front of us. We see our ability to work our way through that and maintain mid-single digits. We clearly have a lot of backlog to clear with $43 billion in backlog. That backlog will ship at mid-single digits. So hopefully those are 3 data points of backlog, future demand, and technology transition that are, and in our guide, that we can maintain the profitability that we've talked about. When we look at the other 2 businesses, traditional servers and CSG that you called out, I think we are operating at a high level of proficiency of changing our price as our input costs are rapidly changing. We began to change price, most notably in servers in mid-December, December the 10th to be specific, and we saw our margins stabilize with higher input costs coming our way. CSG, we were deliberate in delaying moving price because we leaned into a share position. We began that in October. We gained momentum in October, November, and December. You saw that in the share results. Our business grew 18% in a market that grew 10%. We took 100 basis points of share. We chose not to take our foot off the accelerator. We saw a change in the composition of the business in December in particular, with a higher bit mix of large deals, as well as acquisition pricing of new customers. We grew our customer base in CSG, and then we made a price change on January the 6th. When we made a price change on January the 6th, our business normalized, margins stabilized, and they're where they need to be so we can operate within the profitability framework that we've committed to. Hope that was clear enough.
Great. Thanks for
Mark.
that clarity. Really appreciate that.
And our next question comes from Louis Misosha from Daiwa.
Hey, thanks for taking my question, and great numbers, guys. Congratulations. If you look at traditional servers, obviously you're growing exceptionally well in the AI ones. Some of our checks suggested faster growth in that area. So I guess I'm just trying to understand, why numbers not higher for that, more into the solid double-digit range, and are you only seeing inference deployed on AI servers and not yet as much on traditional servers? Thank you.
Louis, let me try to break that down, and I'll ask for David's help on sort of the forward guide. In the quarter, I think we were very outspoken about demand outpaced supply, and traditional servers grew double digits. And we saw that across all use cases in small business, medium business, large multinationals, across all geographies. We saw the continuation of the consolidation that we've talked about and modernization that we've talked about in traditional data centers, where you get incredible efficiency upgrading old technology. For example, our 14Gs converted to a 17G, converts at 6-to-1 to 7-to-1. So you're getting incredible efficiencies in power, space, and cooling, and that continued throughout the quarter, and we're projecting that to continue into Fiscal 27. Additionally, we are seeing AI workloads on x86 pick up. I think that is significant, and we saw that in enterprises. A phrase that we use inside the company is AI forward, so the most advanced enterprises that are really adapting AI are moving quickly, and we saw them use that across a large number of use cases, whether that be software development, scientific computing, whether that be some of the financial traders that are using very sophisticated algorithms. We're seeing that deployed broadly as well as in some inference use cases.